They took their best shot on Friday morning, December 27th, 2024, while most of the world was still digesting Christmas leftovers and scrolling through holiday photos. The banks launched what should have been a knockout blow to silver. The playbook was textbook. Flood the futures market with paper contracts, trigger stop losses, create a cascade of panic selling. They've done this before. They know how retail investors react when they see red. But something different happened this time. By Monday morning, silver wasn't just recovering, it was surging. The spot price blasted through $31.50, then $32, and by Tuesday afternoon we were staring at $32.85. This isn't a dead cat bounce. This isn't a relief rally. This is the moment when the manipulation machine finally broke. And they know it. Right now, in trading rooms across Wall Street, there's a quiet panic spreading, because for the first time in over a decade, they're losing control of the silver narrative. While the mainstream media was obsessing over year-end stock market gains and running their predictable top 10 investment winners of 2024 listicles, the real story was unfolding in the physical silver market, and it's a lie of omission so massive it borders on criminal negligence. Here's what they're not telling you. The London Bullion Market Association vaults are hemorrhaging metal. We're talking about 115 million ounces that have vanished from registered inventory since September. That's not a drawdown. That's not normal seasonal demand. That's a run on the bank happening in slow motion, and nobody in the financial press wants to acknowledge it. They want you to believe this is just another commodity cycle, just another precious metals rally that will fade when the Fed pivots or when some technical indicator rolls over. But here's the kicker. This isn't driven by speculation anymore. This is industrial panic buying colliding with investment demand, colliding with a physical shortage that's been building for 3 years. Samsung just locked in supply contracts for the next 18 months at prices that won't be disclosed publicly. Tesla's gigafactories are consuming silver at rates that would have seemed impossible 5 years ago. And China? China has gone from net exporter to aggressive accumulator almost overnight. This matters right now because we're witnessing the convergence of three forces that have never aligned like this before in the modern silver market. First, you have the solar panel manufacturing boom. Global installations are projected to require 240 million ounces of silver in 2025 alone, up from 140 million just 2 years ago. That's a 70% increase in industrial demand from a single sector. Second, you have the defense industry quietly stockpiling strategic metals as geopolitical tensions escalate. Silver isn't just for electronics anymore. It's mission critical for military radar systems, missile guidance, and advanced communications equipment. And third, you have the paper silver market showing stress fractures that can't be papered over with more derivatives. The ratio of paper claims to physical metal on COMEX has blown out to levels we haven't seen since the 2011 spike, when silver hit $49 and the exchanges had to literally change the rules to stop the rally. Let's be clear. When institutions like BlackRock's iShares Silver Trust are absorbing 8 million ounces in a single week, when the U.S. Mint can't keep up with Silver Eagle demand despite rationing dealers, when premiums on physical bars are running $3-4 over spot price, these aren't signals, these are alarm bells, and the smart money already heard them. In this deep dive, we are going to expose exactly how the silver market reached this breaking point, who's caught on the wrong side of the trade, and why the next 6 months could reshape precious metals investing for a generation. We're going to look at the specific mechanism that's creating this squeeze, and it's not what most people think. We're going to explain why the traditional manipulation tactics that worked for 40 years are suddenly failing. We're going to show you the real-time data that proves physical silver is disappearing faster than it can be mined, refined, or recycled. And most importantly, we're going to give you the strategic playbook for navigating what comes next, because this rally is going to be violent, it's going to be volatile, and it's going to separate the diamond hands from the panic sellers. If you held silver through 2023's grind and 2024's stagnation, you're about to be rewarded. If you're just discovering this now, you're not too late, but the easy money is already gone. This is the story of how a rigged market finally broke under the weight of reality. To understand why this matters, you have to understand the fundamental architecture of the modern silver market and how it's completely different from what most investors imagine. When you hear silver market, you probably picture mines in Mexico, refineries in Switzerland, and bars stacked in vaults. That's the physical market, and it represents maybe 15% of total silver trading. The other 85% is paper, futures contracts, options, ETFs, certificates, and derivatives that exist purely as financial instruments. Think of it like this. Imagine a casino where you can bet on the outcome of a football game, but the casino has the power to change the score if too many people bet correctly. That's essentially what the paper silver market has been for decades. The bullion banks, your JP Morgans, your HSBCs, your Scotia banks, act as market makers. They sell futures contracts representing silver they don't own to clients who mostly don't want physical delivery, creating a massive synthetic supply that suppresses the price. This worked beautifully when industrial demand was stable and investment demand was sporadic. But here's the problem. Starting in 2021, physical demand began exceeding newly mined supply every single year. The deficit has been filled by above-ground inventory, the metal sitting in vaults, waiting to be used, and now that cushion is almost gone. Let's do the math, because this is where the mechanism breaks down. Global silver mine production in 2024 was approximately 830 million ounces. Total industrial demand, solar, electronics, medical, automotive, 5G infrastructure, was roughly 610 million ounces. Investment demand from bars, coins, and ETFs added another 250 million ounces. That's 860 million ounces of demand against 830 million of new supply. A 30 million ounce deficit doesn't sound catastrophic until you realize this is the third consecutive year of deficits. Where does the extra metal come from? Recycling provides about 150 million ounces annually, but that's already baked into the supply side. The real answer is inventory drawdowns. The float, this is the metal available for immediate sale, not the total above-ground stock, has been declining steadily. COMEX registered inventory, which represents silver that's been designated for delivery against futures contracts, dropped from 405 million ounces in January 2021 to 236 million ounces today. That's a 42% decline in the metal that backs the paper trading system. Do you see the problem yet? If even 5% of the open interest in silver futures, currently sitting at around 140,000 contracts, each representing 5,000 ounces, demanded physical delivery, that would require 35 million ounces. The registered inventory could technically cover that, but the logistics would be impossible. The warehouses aren't set up to handle that volume simultaneously. The refineries can't produce 1,000-ounce bars fast enough. The transportation and insurance infrastructure would seize up. This creates what's called a delivery squeeze, when paper contract holders realize they can't actually get the metal they're owed, and the price gaps violently higher as desperate buyers scramble for physical. We saw a preview of this in March 2020, when COMEX silver futures briefly traded at a $5 premium to spot because of delivery bottlenecks. That was chaos caused by COVID logistics. Imagine what happens when it's caused by an actual shortage. This is exactly what happened in January 2011. Silver was trading around $26 when a perfect storm of factors converged. The U.S. Mint suspended Silver Eagle sales due to unprecedented demand. COMEX warehouse inventories were declining, and investment buying accelerated as the QE2 monetary stimulus program flooded the system with liquidity. Within 4 months, silver rocketed to $49.80. But here's what they don't want you to remember about that rally. It didn't end because demand collapsed or because fundamentals changed. It ended because the CME Group, the exchange that operates COMEX, raised margin requirements 5 times in 8 days. They literally changed the rules mid-game to kill the rally. On April 26, 2011, they announced yet another margin hike, and silver crashed 30% in 4 days as leveraged speculators were forced to liquidate. The media called it a bubble popping. It wasn't. It was market manipulation, plain and simple, designed to protect the institutions that were short. Fast forward to today, and we're seeing similar conditions, except this time there's a crucial difference. In 2011, industrial demand was stable. This rally was purely investment-driven, which made it vulnerable to sentiment shifts. Today, the industrial bid is structural and growing. You can raise margins to shake out speculators, but you can't force Samsung to stop building smartphones or tell solar panel manufacturers to find a substitute for silver. History is repeating itself, but with a twist that makes the manipulation playbook much less effective. This creates a trap within a trap. The bullion banks are caught short, they've sold futures contracts betting on lower prices, and now they need to either buy back those contracts at a loss or deliver physical metal they don't have. Normally, they could just roll their positions forward, pushing the problem into future months. But with inventory declining and the threat of delivery squeezes increasing, rolling forward is becoming more expensive every month. The contango, the premium on future delivery dates versus spot prices, is narrowing, which signals tight supply expectations. Meanwhile, if they try to cover their shorts by buying physical metal, they're competing against industrial buyers who absolutely need that silver and aren't price sensitive in the same way. It's a pincer movement. Every rally puts pressure on the shorts. Every dip gets bought by physical demand. The volatility itself becomes a weapon against the manipulators because it forces margin calls and position liquidations on the leveraged players, and increasingly, those leveraged players are the banks themselves. In Part 3, we're going to look at who's on each side of this trade and why the squeeze is inevitable. Let's start with the force that changes everything: industrial demand that cannot be postponed. The solar industry alone has become the single largest source of silver consumption, and the growth trajectory is staggering. China installed 216 gigawatts of solar capacity in 2024. That's more than the rest of the world combined, and represents roughly 110 million ounces of silver consumption just from Chinese solar projects. But here's where it gets interesting. The Chinese solar manufacturers are now forward buying silver on long-term contracts, removing that metal from the spot market entirely. Companies like Longi Green Energy and Tongwei Solar are securing 12 or 18-month supply agreements directly with miners and refiners, bypassing the traditional market structure. If you're Samsung and you're looking at your supply chain for smartphones, tablets, and EV components, you have two choices. Option A, wait for spot prices to come down and risk production delays when you can't source metal. Or Option B, lock in supply right now at whatever price secures guaranteed delivery. The smart money is choosing Option B. Tesla's Gigafactory Texas is consuming approximately 3 million ounces annually just for vehicle electronics and battery management systems. Multiply that across the entire EV revolution. Global EV production is projected to hit 30 million units in 2025, and you're looking at demand that simply didn't exist 5 years ago. This isn't speculative demand. This is the physical economy saying we need this metal regardless of price. While the industrial complex is absorbing available supply through necessity, sovereign nations have quietly become aggressive accumulators through strategy. China hasn't just flipped from net exporter to buyer. They've implemented a systematic accumulation program that's flying under the radar because it's not happening through official central bank purchases. Instead, Chinese state-owned enterprises, provincial investment funds, and private companies with government backing are building strategic stockpiles. Why? Resource nationalism. China learned from the rare earth elements playbook: control the supply chain, and you control the industries that depend on it. Silver is mission critical for military technology, 5G infrastructure, AI data centers, and the entire green energy transition. By accumulating now, while Western financial markets still treat it as a speculative commodity, China is positioning itself to have leverage in the geopolitical competition for technological supremacy. India has also shifted policy dramatically. After years of trying to discourage gold and silver imports through tariffs, the Indian government is now allowing duty-free silver imports for manufacturing, essentially admitting they need the metal for electronics and solar ambitions more than they fear capital outflows. Meanwhile, Russia and other sanctioned economies are converting dollar reserves into hard assets, including precious metals. These aren't traders. These are nations making decade-long strategic decisions. And once metal moves into sovereign vaults, it doesn't come back to market unless there's a crisis or regime change. This isn't just industrial demand. This isn't just sovereign accumulation. This is industrial demand plus sovereign accumulation plus collapsing above-ground inventory plus declining mine production plus retail investment demand all happening at once. It's a perfect storm, and each element reinforces the others. When COMEX inventory drops, it spooks industrial buyers, who then accelerate their forward purchasing, which removes more metal from available supply, which pressures inventory further. When sovereign buyers enter long-term contracts with miners, it reduces the amount of newly mined silver that reaches the open market, which tightens the spot market, which forces short sellers to pay higher premiums for physical delivery. The paper market is still trying to operate like it's 2015, with unlimited synthetic supply, but the physical market has fundamentally changed. Market makers are getting squeezed from both sides. They're short on paper, but they can't easily acquire physical to settle if they need to. The mechanics of this squeeze are already visible. Look at the gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. For most of the past decade, this ratio has been between 71 and 90.1. Today, it's hovering around 88.1. When silver rallies for real, this ratio compresses violently. In 2011, it briefly touched 31.1. That represents silver outperforming gold by a factor of 3. Why? Because silver has much smaller market size and much higher industrial demand as a percentage of total supply. It's leveraged gold, and that leverage works both ways. We are already seeing signs of this breakdown in market structure. In November 2024, the Shanghai Gold Exchange reported silver withdrawals that exceeded deliveries for the 6th consecutive month, meaning more metal is leaving the vault system than entering it. The U.S. Mint has been rationing Silver Eagle production since August, citing supply chain constraints, which is code for, we can't get enough blanks from refineries because industrial demand is consuming everything. Premiums tell the real story. When a 100-ounce silver bar carries a $3.50 premium over spot price, that's not normal. Historical premiums run 50 cents to $1. When you're paying 12% over spot just to get physical metal delivered, that's a shortage signal. Dealers are reporting wait times of 4 to 6 weeks for certain products, not because of logistics problems, but because the metal isn't available. Refineries like Sunshine Minting and Asahi are running at full capacity, but still can't meet demand. The evidence extends to the futures market itself. Open interest in COMEX silver futures has declined 15% since August, even as prices have risen. That's unusual. Normally, rising prices attract more speculative interest and increase open interest. The decline suggests longs are taking profit by demanding physical delivery, and shorts aren't being replaced by new sellers. That's exactly the pattern you see before a delivery squeeze develops. Wall Street hasn't priced this in yet, but they're starting to realize the game has changed. Here's what you need to understand. We are in the early innings of a structural bull market in silver, and the window for accumulating physical metal at reasonable premiums is closing fast. This isn't a trade, it's a position. If you're thinking like a day trader trying to time the perfect entry and exit, you're going to get chopped up by volatility and miss the real move. The institutions that are accumulating right now aren't looking at 3-month charts. They're looking at 3-year supply deficits and asking themselves, where will I source this metal in 2026 when the shortage becomes undeniable? If you're a retail investor with some of your portfolio in silver already, congratulations. You understood the game before Wall Street admitted there was one. If you're underweight or completely out, you're not too late, but understand that every week that passes, the risk-reward shifts. The easy money, buying at $18 in 2020 or $23 in 2023, is gone. We're in the phase where conviction matters more than perfect timing. For different investor types, the implications vary. If you're young with high risk tolerance, aggressive positions make sense. If you're near retirement, silver serves as insurance against currency debasement and supply chain instability. Either way, physical metal beats paper claims. The FOMO is going to be intense as mainstream media finally catches on, but don't chase price, chase supply. Strategy number 1, prioritize physical over paper. If you're choosing between a silver ETF like SLV and actual coins or bars, choose physical every time. Yes, storage is a consideration. Yes, liquidity is slightly lower. But when the squeeze intensifies, you want to own the asset, not a claim on the asset. Buy 100-ounce bars if you're serious about accumulation. Premiums are lower per ounce than coins, and you're not paying for collectability. Avoid numismatic coins and limited editions unless you're a collector. You want weight, not art. Strategy number 2, dollar cost average through the volatility. This rally is going to be violent in both directions. They will try to shake you out with coordinated smashes. The banks will flood the futures market with paper at key technical levels to trigger stops and create panic. If you're buying a lump sum all at once, you risk buying right before a shakeout. Spreading purchases over 3 to 6 months smooths your entry and keeps emotion out of the equation. Set a plan, I'm buying X ounces per month regardless of price, and stick to it. Strategy number 3, understand the paper market is a tool, not a substitute. Silver miners and streaming companies offer leverage to the metal price without storage concerns. Companies like First Majestic Silver, Hecla Mining, and Wheaton Precious Metals will likely outperform the metal itself percentage-wise if this rally follows historical patterns. But, and this is crucial, mining stocks are still stocks. They're subject to broader equity market risk, management risk, and jurisdictional risk. A 30% crash in the S&P 500 will drag miners down regardless of silver's price. Use miners for the leverage, but keep your core position in physical. Strategy number 4, avoid margin and leveraged ETFs. The manipulation tactics might be failing strategically, but they're still effective tactically. If you're leveraged, a sudden 15% drawdown will wipe you out even if you're right long term. Let the institutions blow themselves up with leverage. You be the patient capital that survives. Next week, next month, the volatility is going to be brutal. Not for the long-term trajectory, but for your emotions. You're going to wake up to mornings where silver is down 8% overnight on profit-taking or dollar strength, or whatever narrative they push through Bloomberg and CNBC. You're going to see headlines screaming, silver rally over after a 3-day pullback. You're going to watch your portfolio swing wildly and feel the urge to lock in gains or cut losses. This is the test. They will try to shake you out using the same psychological warfare that's worked for decades, create panic, trigger stops, buy your metal at discounts, then let the rally resume after retail has been flushed out. The difference between winners and losers in this environment isn't who has the best technical analysis or the most sophisticated trading algorithm. It's who has the conviction to hold through the manipulation. If you bought silver because you understand the structural shortage, because you see the industrial demand curve, because you recognize the paper market is broken, then temporary price weakness is irrelevant. It's noise. You're not trading a commodity. You're positioning for a paradigm shift in how the market values strategic metals. We are living through a historic pivot point in the global monetary system, the energy transition, and the geopolitical order. Silver sits at the intersection of all three. As fiat currencies are debased through endless stimulus and deficit spending, hard assets become the only reliable store of value. As the world electrifies transportation, communication, and energy production, silver's unique properties, highest electrical conductivity, highest thermal conductivity, most reflective metal, make it irreplaceable. As nations compete for technological supremacy and resource security, commodities become weapons and stockpiles become strategic priorities. This isn't about making a quick profit on a metal trade. This is about understanding that the rules governing markets for the past 40 years are breaking down under the weight of reality. The paper-silver market functioned as long as physical supply was abundant and demand was predictable. Neither is true anymore. Congratulations to the diamond hands who held through the manipulation, through the media mockery, through the years of watching Bitcoin and tech stocks make flashier gains. You understood something the mainstream missed. Real assets matter when the game changes. For those just realizing this now, welcome to the trade. You're early to the momentum phase, even if you're late to the accumulation phase. Silver's historic rally has officially begun. Not because of hype, not because of speculation, but because the market can no longer ignore physical reality. They wanted you to believe this day would never come. But it's happening right now.